Hello friend, happy planning. Your fixed deposit giving you 6.3%. Sound nice and sound safe. Let me show you the real number. So if you are in 30% tax bracket, so 6.30% after tax deduction, 1.97% tax deduction, it became 4.33%. And right now, inflation running at 4.38%. So just do the simple math. So your fixed deposit after tax, after inflation is giving return near to zero. But today I am not comparing return. I am comparing most people never look at, that is risk. FD versus multi-asset versus pure equity. So which giving you highest return, but which one shakes your portfolio how much? So let's see all three honestly. First, let us understand the basic difference. A fixed deposit means one thing only. Your money sitting in bank with a fixed rate. It is simple but very much limited. A multi-asset fund is totally different. As per SEBI rules, this fund must invest into 3 or more asset class. Normally equity, debt and gold with minimum 10% each. So when one is not doing good, other will balance it. That is the whole idea. Smoother the journey, not just chase the highest return. This is not only equity risk, friend, this is pure mix. Now let us compare using actual number return wise. So multi-asset category has given 14.79% over 5 years. But fixed deposit has given 6.30%. So multi-asset clearly ahead of return. But friends, return is only half of the story. The other half is how much your investment shake up and down. So in finance, we measure this particular volatility by one number called standard deviation. Simple meaning, bigger number means bigger ups and downs, and the smaller number means it is smoother. You will never see standard deviation in negative number. So as fixed deposit, there is no volatility in fixed deposit. You will get fixed rate of return. That is why fixed deposit standard deviation is 0 over here. So let's see the actual number. So fixed deposit here, standard deviation is 0. Bank give guarantee on this particular investment. It does not move. It's just like a full stop. Pure equity. For example, a Nifty 50 index standard deviation is around 13.2%. It means here standard deviation is high. It means when market fall, so equity fall higher than fixed deposit, and obviously, and then when market goes up, when it is like bull market, so potential of giving higher return is very much higher. So it is volatility is very much high. And ups, downs, ups, downs. Now multi-asset fund. So standard deviation over here is 9.8%. See this carefully. So this is meaningfully lower than direct equity. So direct equity 13.2, and here standard deviation is 9.8, but return is still far. See, this particular data has one actually biasness in the sense, because multi-asset we have taken only 5 years data. So we got only 5 years data, but equity Nifty 50 we took since inception. Okay. So last 5 years, equity, because from October 2024 onwards, equity has not performed well because of global uncertainty. Equity has a volatility, but that particular point of time, gold has outperformed. Okay, so gold and interest rate also. So that is why you can see this particular multi-asset, this particular time period, it has given higher return. But still we can, still for understanding purpose, in this particular scenario, I'm not talking about whole. Whole as a, so if I want to take means apple to apple comparison, then I might take multi asset also same time period. But as that particular data is not available, so I'm just taking, so this is for illustrative purpose, for understanding purpose only. Here, when we compare two portfolio, so here we can see by taking lesser risk, my multi-asset portfolio has delivered higher return. And obviously, as it has three asset component, so when one will not do good, other two will cover, or two will not do good, third one will cover. So this, it has probability. That is why standard deviation is lesser, and most of the time, majority of the time you will see it has lesser standard deviation than the direct equity. Here FD, see standard deviation, the volatility risk is 0, and here in spite of risk is 0, it is delivering 6.30% of return. That is why we actually, when you do financial planning, so you need to understand what is your time horizon, what is your goal, okay, and each goal has how many times, and what is the importance of that particular goal, and so a lot of things are there. So that is why we need to do our diversification properly. We should not keep 100% into equity, we should not keep 100% into debt, we should not we may or may not keep 100% into multi-asset. It all has its own markets, own upside and downside, and we need to understand the market cycle as well. So a lot of factors is there. That is why personalized financial planning is very much important, and along with personalized financial planning, we need to do proper asset allocation and time to time basis proper review, and whatever changes needs to be done, we will do it accordingly. This is the real value of multi-asset. This is not the highest return option. It's not the lowest risk option as well. And it is in between. So capturing good part of equity growth and while cutting downside part of equity share in one line, better return than FD and smoother ride than pure equity. So now let's be honest. I'm not telling you close all your FDs today. Let us be fair and see where FD genuinely wins. One, capital protection. FD principal is guaranteed and up to 5 lakhs is insured by DICGC. Zero standard deviation is not only a number, that certainly has real value. Two, short-term goal. Money needs in 6 months or 1 year. Every zero checks number is matter more than small extra return. 3. If markets ups and downs genuinely disturb your sleep, that peace of mind worth something too, even at lower post-tax return. For multi-asset, it time 3 to 5 years. And ideally, direct equity needs around 7 years and more. So friend, the real question is not which one give you more return. The real question is how much check can you handle and how much time does your money have. So most people pick investment by only looking at past return, but never have asked about the risk. Friends, so today to understand your risk profile, your goal, your risk appetite, let's sit together for a data-driven financial solution. So you can contact me in below given WhatsApp number and fix up meeting in both of our convenience. We can do video conversation meeting, or you may come to my office. So hope by this particular video, I should able to create some value in your life. Thank you. Happy planning.